let's put the focus on private credit, talking about defensive income. But I do have Patrick William from Rixon Capital here with me now, and I would like to get his view on that breaking news. Now, Patrick, question without notice. I realize you don't have the data in front of you. However, interest rates matter
They do.
across all asset classes. Do you feel, when you see the level of activity out there at the coalface, that there could potentially be a need to hike rates in Australia?
The 3.8% inflation, I think odds are there's definitely not going to be, I'm certain there's not going to be a rate cut. I expect at least one rate rise next year.
Does that change the dynamics for what you're doing at Rixon?
No, it's good for us because it keeps normal rates high, so it keeps our returns at the higher end of our target range. So we're an asset-backed lender. We focus on monthly cash flow, so it doesn't really impact us.
It's an interesting one, isn't it? Because like in the US economy, it's almost like there's two speeds. Again, you've got the haves and you've got the have-nots. Those that are doing well, even as we see inflation sticky or rising, as we've just found out. And then you've got those that are really struggling with the high cost of living, high cost of housing, etc. So it's really hard to sort of understand the dynamic between discretionary, isn't it, and essential.
Yes.
How do you think about that?
Look, that's a very good point. So that's particularly specific to consumption and consumer discretionary. So the way we look at that market is what we've observed is the middle class is the group that's always squeezed, the wealthy aren't, and the people in the bottom 10% aren't either because they're on government revenue streams. So those two bookends are actually quite safe and quite stable. It's the middle market we'd be concerned about.
Mm-hmm. So when you're thinking about the middle market, then how does that help inform your investment decisions?
Straight into retail and hospitality. Those are real areas of concern for us because while a wealthy person might go to a restaurant, it's the mass middle market that is actually they're the people that keep the restaurants full. So as a general rule, for the last 18 months, we've avoided anything that's got direct exposure to discretionary spend for that reason.
So you are looking for opportunities in the essential spend space?
In the essential spend space. So consumer essentials, there's not much of that, but definitely in the business essentials rather than the business discretionary.
So how, if we can summarize, how do business essentials or consumer essential services perform differently than others?
So essential services are, effectively the infrastructure behind how our economy works. So real estate services, your real estate agent will always be in business. Transport, logistic, agriculture, particularly Australian agriculture. So they've got low earnings volatility and they're reasonably high barriers to entry. So you don't get the 10 and 15% growth rates. So they're not exciting for equity and they don't get a lot of headlines. But for a debt provider looking for defensive income, these are businesses in bad times do 1% growth per annum, in good times do 5%, which is perfect for a debt provider.
Okay, so that matters for investors then, the division and the classification of essential services, because it can ensure steadier returns?
That's right. It's a good way to ride out a difficult time in the economy because when the economy is booming, it doesn't matter where you send the money. You get your interest and you get your money back, but when there's economic uncertainty, the essentials are where you will get that defensive income where if there's more pain in the economy, rate rises, a bit of government austerity, these businesses will still chug along, rain, hail or shine.
Yeah, well, we're hearing about government austerity right now as well. So when it comes to the opportunities on offer here in Australia, are there plenty in those essential services space?
Definitely. There's always plenty of deals in that space. So it's a competitive market for that reason. Again, if you segment that, the banks do the large borrowers. There are a group of large funds that'll do the 20 to 50. And then Rixon's got its patch in the $2 to $20 million niche. So enough to keep everyone busy.
Yeah, okay. Look, one thing that everybody's talking about is that we've had more private credit failures, not here in the United States. Should we be worried?
No, is the short answer. It's what I call the great private credit panic. That's what we've got at the moment. So to use that specific example that's popped up this week, it's a business called Renovo. It's a builder roll-up. So, your contractor rolling up $1 billion worth of other contractors backed by BlackRock. The business was geared to the gills, had $150 million of debt against less than $1 million of assets, and exposed completely to consumer discretionary. It's not surprising it went under in the current economic situation, whereas people don't leverage like that in Australia.
And so, is that a cautionary tale as we see these new regulations developed by ASIC potentially, that we just need to keep a lid on, what part of the lending environment?
I think Australian investors just won't tolerate that level of leverage. So there's enough common sense in this market that we'll never end up like the US. And the ASIC review is more around transparency, where there is room for improvement. So the industry needs to smarten up. But in terms of the way we underwrite very well in Australia.
Okay, so if you had a crystal ball, which I know you don't, but you don't expect to see these kinds of blow-ups here?
Not at all. Not at all.